A customer taps transfer in their banking app and the funds arrive as quickly as a text message. This is possible with peer-to-peer payments available to roughly a third of the world's population. Today, I want to show you how to set them up with stablecoin. My name is Przemysław and today I invited our analyst Szymon to help me explain this process. Szymon, the stage is yours.
Thanks for the warm welcome. Let's dive into the subject. First, let's define the objective. We want peer-to-peer cross-border payments, for example, in the Gulf region. So customers in, say, the UAE will be able to send money to Bahrain in seconds. Today, instant rates in the Gulf clear inside 30 seconds, but only within one jurisdiction and usually below set limits. For large cross-border payments, it can take up to 2 days. With a stablecoin, we'll try to reduce the time to 5 seconds. The system must also follow American KYC standards because many correspondent banks demand it. The conditions we have to meet are outlined by a Wolfsberg questionnaire. The fee should not be more than a fraction of a cent. We also want to comply with all local and international regulations and begin by establishing retail payments first, moving to interbank payments in the future. Let's sum up the objectives. We want to quickly build a fast, low-cost, fully compliant payment system, first between people, then between banks. Okay, so how do we accomplish this? We need to make a design choice. Let's talk through our choices for the coin itself. We have 3 options. Adopt a public USDC, create a white label dollar token with Paxos, or mint our own fiat-backed coin. Let's examine these options. If we decide to adopt a public USDC on Stellar network, we will be able to settle the transaction in roughly 5 seconds. One transfer burns only a 100,000th of a lumen, which is about a fraction of a US cent. We also need to ensure liquidity. There can't be any delays on, for example, the salary day. Circulating USDC on Stellar sits near $151 million, about 0.25% of total USDC in issue. It has doubled in the past year, yet we must still keep buffers and monitor peaks. We also have to figure out a way to run custody. I suggest we go with Fireblocks. More than 2,000 institutions use its multi-party computation, and the platform has already secured over $10 trillion in digital asset transfers. That gives us bank-grade signing policies without building hardware security modules ourselves. Okay, this sounds solid, but what about the other options? What if we badged a token with Paxos? Paxos operates in Abu Dhabi global market. We could pay it to mint a dollar token that carries our name while Paxos manages reserves and attestation. Standard Chartered holds the collateral, so we will avoid balance sheet drag. However, Paxos issues stablecoins on Ethereum and Arbitrum. We would need a bridge on Stellar or else run those chains directly, which increases complexity. This is doable, but let's skip this option for now. The third route is our own coin. We would form a special purpose issuer, place full value reserves, and obtain a new license. Abu Dhabi consultation paper on fiat referenced tokens outlines capital, audit, and disclosure duties. Review and approval could take close to a year. As we have discussed at the beginning, we want the fastest path to market. That is why now, for this particular case, we choose the first option. This way, we already have a compliant coin, rapid settlement, minimal fees, and proven custody. Regulators treat us as holding a spot asset, so the licensing burden is lighter. We can learn from live traffic and later decide whether to badge or issue our own token, for example, on a domestic currency.
Before we move in our pixel, we need a regulator that welcomes crypto and understands banks. 3 stand out today: Abu Dhabi Global Market, the DIFC in Dubai, and the Central Bank of Bahrain. In the United Arab Emirates, we can apply either for the RegLab sandbox or a full money services permission through the Abu Dhabi Global Market. If we simply hold USDC, the sandbox route can sign off in roughly 6 months. If we decide to work with the Dubai International Financial Center, we'll file for a Category 3D Managed Services license or the Innovation Testing license. Until February this year, USDC was not on the DIFC recognized token list. Circle secured that approval in February this year, so the regulator is already comfortable with the coin we plan to use. Bahrain is a good option as well. It treats custody and transfer under its crypto asset module. If we later mint a coin, we must clear the stablecoin issuance and offering module, a brand new text from 2024. That module demands daily reserve reconciliation and a monthly audit, but we do not need to worry about that for now. Each of these regulators will set some expectations we will have to meet before launching, but also some that we will need to comply with on a day-to-day basis. Here, choosing Fireblocks as our custody tool helps a lot. The moment a customer presses send, Fireblocks routes the transaction through 3 parallel checks. First, it screens the wallet address itself. With Chainalysis, it risk scores the destination. Anything linked to sanctions, darknet markets, or mixers is blocked on the spot. Second, it runs transaction-level KYT to catch structuring or unusual velocity. Third, it triggers a travel rule handshake with the counterparty virtual asset service provider using Nota Bene's API inside the Fireblocks console. Let me explain the last point in a bit more detail. When transactions move across the network, they pass through several points or hops before reaching the final destination. Every hop must come with the attached originator and beneficiary data. In Abu Dhabi global market, for example, the rule is a no de minimis threshold, meaning every transfer needs full travel rule data, no matter how small. Fireblocks can read the jurisdiction code we pass in the metadata and decide whether to attach the customer data whenever the travel rule applies. We want to follow American KYC standards because many correspondent banks demand it. We have to complete the Wolfsberg CBDDQ. That questionnaire is the lingua franca for large dollar clearers. We will staple 4 artifacts to it: our KYC policy, the travel rule standard operating procedure, the Chainalysis Fireblocks wallet risk matrix, and the model validation memo for our transaction monitoring rules. Wolfsberg recommends we refresh the pack every 12 to 18 months, so we will set a diary reminder upfront. Alright, so to sum up this part, we now know how to pick the home regulator, obtain the Managed Services license or sandbox node, flip on Fireblocks' wallet screening, KYT and travel rule modules, and wrap the whole thing in a Wolfsberg CBDQ dossier for our US dollar clearing bank. We need to decide how we run the platform day to day without ever losing customers' data or keys. To do this, we will need 3 defense rings. The outer ring is the cloud. We will park every microservice in either AWS or Azure, UAE, because both providers guarantee local data residency and already hold the compliance badges the central bank and DIFC ask for. AWS even runs a financial services compliance center in Abu Dhabi that maps its controls straight onto the regulator's checklist. Both providers let us pin storage, logs, and key materials to Emirati zones, which satisfies the central bank's cloud computing rulebook on localization and border-proof exit plans. The same setup also clears the Abu Dhabi data protection laws, which insist on encryption at rest, annual pen tests, and a lawful basis for any export. The middle ring is key custody. We hand that to Fireblocks' MPC CMP engine. Every private key is split into mathematical shards. 2 shards live in our own AWS or Azure nodes, and the 3rd shard stays with Fireblocks in Europe for redundancy. No single machine ever sees the whole key. Fireblocks open source the code so our auditors can read every line. If a data center burns down, we invoke Fireblocks' new disaster recovery service and rehydrate the workspace in Bahrain within 4 hours. We also need to guarantee speed. Therefore, for the innermost ring, the transaction layer, we choose Stellar. We run our own validator and Horizon API server in the UAE, which keeps a round trip under 300 milliseconds. Stellar closes a ledger in about 5 seconds today, and the roadmap is pushing that to 2.5. Alright, I think I have a nice sketch of our infrastructure. Let's let Shimon walk us through a sample transfer now.
A payment request lands on our API gateway in AWS. A compliance microservice then calls Fireblocks. There, we verify the wallet risk score, velocity checks, and policy approvals. Once cleared, Fireblocks assembles the MPC signature and broadcasts the USDC transfer to our local Stellar validator. Horizon confirms finality in 5 seconds, sends the callback, and the mobile app flips from pending to done. Every step is encrypted, logged to our write once S3 bucket, and replicated to the Bahrain region for disaster recovery. Seems like a plan. The regulators will be able to see the data stays in the country, keys are never whole, and every ledger entry can be verified. That ticks each regulator security boxes in one go. Legal and compliance sign-off should be a formality instead of a blocker. The cloud is locked down, the keys are sliced into MPC shards, but what do our customers actually touch?
The first thing we do is spin up a wallet for every customer right inside the banking app. Fireblocks has a wallet as a service API. You call one endpoint during sign-up and it creates an MPC wallet in under a second. We will stick to that for our system. Customers will want to move money between their fiat account and on-chain USDC in seconds. So we need a cash bridge or an on and off ramp. We lean on a Stellar anchor called SAP24. The anchor takes a push payment in dirhams, mints the matching amount of USDC and drops it straight into that new wallet. The whole loop should execute in about 15 seconds. And if the user wants cash back into their fiat account, they hit withdraw, the anchor burns the USDC and pushes dirhams back over the payment platform. It is very important to make withdrawing just as fast as the top-up. If loading money is instant but withdrawing takes a day, your new users will not trust your solution as much as they could. Our conversation has for now been very technical, especially in relation to blockchain. Obviously, we do not need and do not want to scare users with crypto jargon. Therefore, we'll keep 2 balances on the dashboard. Available balance in, for example, dirhams and digital dollars in USDC. Behind the scenes, the app pulls Fireblocks for wallet history and Horizon for pending transactions. But the user just sees a normal ledger and a green tick when it settles. We want people to use this wallet for payments, that is the whole point, but how do we achieve it? The payment screen will look like in any other wallet app. The user picks a contact or scans a QR code. We reuse the phone number payment platforms like Ani already use and map that number to the person's Stellar address. QR usage is exploding in the Gulf with year-to-year growth of more than 200%. So we will write on an existing habit. We will also add an optional memo field. Businesses need references, invoice numbers, VAT IDs, and notes for reconciliation. We will keep a 140-character memo off-chain, but link it to the transaction hash to satisfy business need without putting personal data on a public ledger.
Customers can now send USDC to one another inside our app, but we need to speak to other banks, card schemes, even SWIFT. Otherwise, our shiny rail is an island. Let's start with banks that don't run Stellar. We can bridge through anchors, regulator gateways that swap bank money for on-chain tokens. Suppose a customer in Dubai wants to pay her cousin in Bahrain. Our UAE anchor takes dirhams through Ani, mints USDC on Stellar, then Bahrain anchor redeems the USDC into dinars. Anchors matter because they give user local cash in and cash out. Without them, tokens would be trapped in wallets. But what if the cousin wants euros, not dinars? That's where path payments come in. Stellar lets us send USDC and deliver EuroC in a single atomic hop. USDC to Lumen to EuroC, all inside one transaction. The network locks in the exchange rate, so neither side takes volatility risks. We need it because manual exchange conversions would kill the instant experience. If the other bank also runs Stellar, we can open a private corridor, a shared Fireblocks workspace seeded with intraday USDC. This way we can settle balances in seconds and don't have to wait for end-of-day SWIFT batches. If the counterparty isn't on Stellar, we still redeem USDC through our anchor, and push dirhams over ANI. Private corridors are essential because they shrink intraday liquidity costs and let both treasuries reconcile from the same real-time ledger. To give merchants access, we need to integrate with Visa's and Mastercard's API. Visa already settles merchant acquirers in USDC on several chains and is expanding chain-agnostic support. Mastercard's crypto credentials maps blockchain addresses to aliases. Tapping those APIs lets a cafe accept USDC while still receiving dirhams overnight. Card scheme hooks matter because they turn our rail into spendable money, not just a P2P tool. SWIFT's 2023 tokenization pilot with UBS and Chainlink proved you can slip an on-chain transaction hash into a GPI message without breaking the SWIFT schema. A SWIFT GPI message is a standardized SWIFT MT message that includes additional tracking information. It allows financial institutions to track the payment in real time, even if it undergoes a currency exchange. We'll take the hash horizon returns for every USDC transfer, embed it in the GPI payload, and our operations team will still see the familiar dashboard. Keeping GPI in play matters for two reasons: no retraining for staff and an unbroken audit trail for compliance reviewers who already rely on GPI end-to-end tracker. So we have covered personal, merchant, and cross-border payments. For regulators, it is also important to establish how we will settle systemically important payments. Systemically important payments systems are vital for the smooth functioning of the economy, financial system, and financial markets. They are typically large value payment systems or real-time gross settlement systems, and their failure could cause significant disruptions within the financial system and the economy. That's where a RTGS integration comes in. After the on-chain leg clears, a middleware service converts the settlement advice into an ISO 20022 compliant message and posts it to the national RTGS quay. Let's check the full map. Anchors move cash between bank accounts and tokens. Path payments do instant currency exchanges. Private corridor settle interbank transfer in seconds. Card APIs let merchants accept the coin. SWIFT GPI keeps the existing tracking dashboards, and RTGS gives the central bank its finality. This way, we are not tearing our legacy rails, we are laying faster, cheaper tracks underneath them. That way, treasurers, merchants, regulators, and customers all keep the workflows they trust, while we deliver faster 24/7 cross-border settlement. Let's establish how we will roll this out. I suggest we launch the system in 4 steps. Phase 1, the sandbox pilot. We file for ADGM RegLab or the DIFC innovation testing license. Those frameworks cap us at 500 users, 10,000 dirham tickets, so any bug or compliance misses will stay small. We limit the corridor to UAE and Bahrain because there are already anchors on both sides. The goal is simple. Every transfer must settle in under 10 seconds. Cost under a cent, and trigger 0 sanctions hits. If we can't clear that bar with friends and family, we fix the tag before a single retail customer sees it. Let's say the pilot is successful. To move into phase 2, invite the regulator to watch our live logs. Once they sign off, we can build a consumer MVP. We upgrade to a full category 3D license, open the wallet tab to entire UAE retail base, and bolt the ANI on-ramp, off-ramp to the app. We'll focus on domestic transactions first to avoid dealing with currency exchanges and sanctions lists. We are aiming for 5,000 active wallets and an NPS north of 65. If the customers hate it, we stop there. If consumers like it, we step into phase 3 with cross-border and B2B payments. We add high-volume remittance lanes like UAE Saudi Arabia, UAE Pakistan, and UAE India, because fees there are still 6% on average. Cutting that to under 1% proves the business case. We also open business wallets with path payments exchanges so importers can pay invoices in euros, reals, or dinars straight from USDC. liquidity. That's the moment the treasury sees real float in the corridors and liquidity pools start to deepen. In our last phase, we will invite other banks to our network model. By now, we have the metrics, the regulator's blessing, and enough volume to tempt peers. We sign bilateral MUs, set up shared Firebox workspaces so treasuries can settle intraday in USDC and keep the RTGS bridge for anything systemically important. If the central banks, digital DRAM, pilot, matures, we plug that in room moving from commercial bank money to tokenized central bank money at final settlement. And that's it. Now, hearing those neat milestones, 500 users, then 5,000, 10-second settlements, makes this sound almost too tidy. Real life will throw curveballs at us, I can guarantee that. Are we painting an idealized picture? Absolutely. Every number we've used is an example so we can talk the same language. The moment we go live, bottlenecks will surface we haven't dreamed of. An anchor's bank account could hit a liquidity limit, or the DIFC could change a reporting format mid-pilot. Stellar liquidity could thin out on a week. Those frictions are inevitable, but the upside is enormous and specific to this region. Gulf cross-border retail payments still average close to 6% fees and shut down overnight. Remittances to South Asia alone top $180 billion a year. If we own the first rail that settles those flows in seconds for pennies, we are winning primary relationships with customers. That's it. If you enjoyed this video and need help building such a system, please don't hesitate to reach out. We have prepared a slide deck, a checklist, and key sources we quoted, all attached in the description. Use them, challenge them, improve them. Also, watch our other content on the topic of stablecoins, and as always, remember to stay on the block to stay ahead.